Good afternoon, and thank you so much for joining us for session 1 of our 2021 ACA series. My name is Casey Hope. I am the Director of Marketing and Communications here at Medcom Benefit Solutions. And our session today is on ACA penalties and the American Rescue Plan Act and how things have changed and updated due to all of the regulations that have come out recently in ARPA. So one thing I want to address first off here in the beginning of the webinar is to let everyone know that this is an ACA series. So we are going to be strictly talking about ACA and how ARPA has affected ACA penalties and potential changes to filings for 2021 and moving forward. We will not today be discussing any COBRA changes, COBRA subsidies, or the outbreak period. However, we know that that is still a very hot topic. We know that it is very confusing, and although we're all trying and getting better at understanding it, there's still a lot of questions out there. So for the convenience of all the attendees, we have uploaded in the handout section of your GoToWebinar some information that we've put together over the past month or so. We have our outbreak period and ARPA question and answer sessions, session 1 and session 2. We've got the PDF handouts there. In those PDFs, we talk about the subsidies, involuntary, voluntary termination. We covered dependent care changes and questions about the notices and the outbreak period. We also have a 2021 FAQ for brokers about ARPA and the outbreak period. And we have some talking points for the outbreak period. That was created back early March, so it's just kind of going over the regulations that were put out and released regarding the outbreak period on February 26th. So knowing that we're not going to spend any time talking about COBRA, we did want to have those resources available for you today. We asked it, hope that you can take advantage of that. And also keep up with us on social media and on our YouTube channel for any other information that we have posted there. So with that being said, let's get started with our session 1 of our ACA series. I'm joined today by Michelle Barkey, our Senior Legal Counsel and Director of our Compliance and HIPAA Department, and Tom Neal, our Medcom Sales Associate. They will be tag teaming the presentation today. The presentation is being recorded, and we will be able to provide the recording link and the slide deck to you after the webinar concludes today. And as always, we will have a Q&A session at the very end where we'll talk about any of the questions that's come up related to ACA and penalties and changes due to ARPA. So I'm going to go ahead and move forward and turn this over to Michelle Barkey.
Thank you very much, Casey, and good afternoon, everyone. Today's agenda, we're going to talk a little bit about the IRS and how they're becoming more and more unforgiving as far as penalties are concerned. We're just going to do a quick review of the applicable large employers' responsibilities and potential penalties. And then we're going to talk about the ACA and a couple of changes that have come down regarding the American Rescue Plan. Now, the first thing I always like individuals to understand and employers to understand in particular is the IRS Mission Statement, because it actually says it all. And basically their mission statement is to provide the American taxpayer top quality service by helping them understand and meet their tax responsibilities and enforce the law with integrity and fairness to all. So their job is to make sure that you understand your responsibilities and also to enforce the tax code. And with that, along with their application of the mission statement goes, they say that in the United States, Congress passes the laws and requires the taxpayers to comply. And then they say the taxpayer's role is to understand and meet their tax obligations. Sounds very, very unforgiving, doesn't it? And then the IRS's role is to help most compliant taxpayers with the tax law while ensuring the minority who are unwilling to comply pay their fair share. And they don't care whether this is corporate or individual, and the ACA is part of the tax code. So how does it, the applicable large employer's responsibilities and potential penalties fit into the tax code? Well, the first thing we always have to remember, and we talk about this all the time, is that applicable large employers must offer to 95% of their full-time employees coverage that meets the minimum actuarial value and be affordable. And that's under section 4980HA and 4980HB. So you either get an A penalty or a B penalty if you fail to comply. There is reporting obligations, and that's under code section 6055, which says all providers of insurance must report on the coverage that that someone accepted. So typically in the past, that's been done by the carriers. There is some relief from the carriers from doing it as long as the information is readily available. And there's an indication on their website posted as to how an individual can go ahead and get that 1095-B. But there is absolutely no forgiveness if you are a self-funded health plan and must report on Part 3 of the tax form 1095-C. So that's 6055, and then 6056 is basically all applicable large employers must report on the coverage that they offered to their full-time employees, because this is how we determine whether or not they met that requirement of offering 95% coverage to 95% of full-time employees, and whether the coverage was affordable and whether it met minimum actuarial value. So 6056 tells us all that information on those 3 lines, 14, 15, and 16 on the 1095-C. And just a reminder, 4980HA penalty is for failure to offer coverage to 95% of your full-time members. You are then penalized on all your full-time members minus the first 30 if one individual goes to the marketplace and gets a subsidy. Way back in 2015, the penalty was annualized at $2,080 or $173.33 a month. Now we're way up in 2021, and the penalty is $2,700 annualized and $225 per calendar month. Now the 4980HB penalty is if you fail to offer coverage that met minimum actuarial value or wasn't affordable to an individual. And that penalty is only assessed if the individual went to the marketplace and got a subsidy. So this is more or less an individualized penalty. And because of that, the penalty amounts are higher, but the penalty may be lower overall because you're not talking about all your full-time employees. You're only talking about those that actually went to the marketplace. So in 2015, the penalty was $3,120 annualized, or $260 per month. And now it's $4,060 annualized, or $338.33 a month. So those penalties do really add up as well. And again, we talked about 6055 and 6056 and failure to file and failure to furnish. Failure to file means that you failed to file these timely with the IRS, and fail to furnish means you did not give a copy to your full-time employees, which you must do. So for every form that you did not file and furnish, in 2015, the penalty was $250. We don't know what it's going to be for 2021 at this point, but it was $280 in 2020. And I imagine it's going to go up to $290, but I do not know for sure. So you must make sure that you file all these forms with the IRS and you give them to the employees. Now, we've been lucky for the past few years. We've had this good faith effort to make the forms correct and to make sure that we get them out. Unfortunately, the IRS has not defined what a good faith effort is, so they can charge you if mistakes are made. And again, those mistakes would be $280 in 2020 per form that was filed wrong or furnished wrong. Generally, if you make the corrections within 30 days, the fine goes down to $50. And if you file or furnish or correct mistakes by August the 1st, the penalty goes down to $100. So it's really important that we do this. Now, one of the other things is over 250 forms, you must file it electronically. Otherwise, you face the 6055 and 6056 penalty. And it could be up, as I say, to $280 per form that you mail to the IRS rather than give it to them via the electronic method that they've set up through the AIR system. One of the things you might not be aware of is there is absolutely no statute of limitations on filing the 1094 and 1095C. You know, typically with tax years, unless there's real fraud involved, the statute of limitations is 7 years. But I get often asked, can the IRS come back and look at my 2015 returns now? And the answer is yes. And in fact, they have been. I got a couple recently from 2015. Currently, they're working on 2018, but occasionally you'll see one that comes in from a prior year if they have questions. And typically what happens is they looked at 2018, noticed an error, went back to 2015 and 16 and 17. So there is absolutely no statute of limitations. So what does this mean? It means that you should keep your forms indefinitely because the IRS can come back indefinitely. How do we know that there's no statute of limitations? Well, the Office of the Chief Counsel for the IRS declared it as such. And the reasoning behind it was when you file, you're not asking for a tax obligation at that time. You're just showing compliance or non-compliance. And therefore, because of that, there is no tax limitation, no statute of limitations. Now, what has changed recently that makes all this really, really important now and what we're expecting? Well, number one, we have a change in administration. We're now under the Biden-Harris administration. Don't forget, President Biden was very much in the forefront of the Affordable Care Act when it was passed in 2010. Don't forget that all the way through the campaigning, he indicated that he was much in favor of the ACA and the penalties and everything else. So his goal is to enhance the ACA, where we know the previous administration's role was they were trying to tear it down. So what we have noticed recently, and part of it was due to COVID and part of it was just because we believe they're going to get more aggressive, is all of a sudden we're starting to see a real influx in the penalty notices. And penalty notices of all types, from the 226Js, where you might have failed to offer coverage to 95% of your full-time employees, or they were not affordable, the coverage was not affordable, right down to the fact of failure to file and failure to furnish. And we also noticed a change in those failure to file and failure to notice, failure to file and furnish. The original notices that came out a year or two ago were kind of gentle. And they said, you know, we think you're an applicable large employer, are you? And if so, are you going to file? And can you file within 60 days? Well, that nice, easy language has disappeared. And now they're just saying, we believe that you're an applicable large employer, you haven't filed. And the next notice to you, if you don't reply to this telling us we're right or we're wrong, is that we're going to send you the penalty notice and how much you owe. So they're getting a lot more strict, and they're not kind of giving you an opportunity to go back and file. So again, it's going to be on a much higher standard, which is reasonable cause. Why didn't you file? So we've seen that drastic change as well. And then on top of it all, for those of you who may not know, in June of 2020, the Treasury Inspector General for the Taxpayer Advocate actually reviewed all the processes that the IRS had in the ACA for the employer shared responsibility, and also how much they had collected in the past. And the report was absolutely scathing to the IRS, and it said, you will do a better job. And they told the IRS, you better start defining what good cause is, because, you know, we've had for the past 6 years, if you make a mistake on your form and it's good cause, there's not going to be a penalty. And the IRS says, maybe you should look at that and say what a good cause is. And if you just make a careless mistake, maybe you should be charging a penalty. So the IRS is also kind of has a bit of sting from this report from the Treasury Inspector General for the Taxpayer Advocate. So we must be aware of that as well. So those are some of the things that have changed. And then we had what changed with the American Rescue Plan and why it matters and why it might seem a little bit, you know, well, why would this matter to me? It is really, really important. Don't forget, when you look at the 4980HA penalty, those penalties are triggered if you have one individual that goes to the marketplace and gets a subsidy and you fail to offer coverage to 95% of your full-time employees. And the 4980HB penalty is if you fail to get coverage and the coverage that was offered was either unaffordable. Now, if you remember when we went back into the marketplace the past couple of years, the marketplace open enrollment was limited, as it has been each year, which is basically from the middle of November to the middle of December. But unlike in previous years, this past year and the year before, it wasn't really advertised on TV. They didn't say, hey, you know, the marketplace is open like they used to. So maybe we had a lot of employees who we were banking on not going to the marketplace, who might not have gone to the marketplace. However, with ARPA, there was a couple of changes. First thing is, in the past, the subsidies were only available if you received, if your income was based on the federal poverty guideline. And for an example, for single coverage only, or for however family members you had, you could not, you know, it was based between 100 and 400% of the federal poverty guideline. If you earned above 400% of the federal poverty guideline, you were out of luck and you would not receive a subsidy. However, that has changed at the marketplace, and that 400% under the American Rescue Plan has been waived. So now we're looking at 100%, and it could go on indefinite. So before, an individual who was making, a single individual who was making $52,000 a year would not have been eligible for a subsidy, but that's no longer the case. So in some of the pay and play analysis that were done in the past to see, you know, a guesstimate and an actuarial study as who might go to the marketplace and who might get a subsidy, we always looked at those employees that were making, you know, between $50,000 and $100,000 and saying, we know they're not going to get a subsidy, so we're safe. We don't have to worry about them going. Now that's not the case. The second part of it, besides increasing it, is that they've now adjusted the percentage of the subsidy. So before you could get between 0 and 8.5%, but now that's increased. So you could get up to 2.6% to 9.78% increase in the subsidy. So there's a big increase in the amount of the subsidy that you can get at the marketplace, and that is also affecting the marketplace. And finally, we know that the marketplace was reopened. It was reopened in February, and it's going to be remained open until August the 15th. And they're starting to advertise more and more that the marketplace is open and you can go and potentially get a subsidy at these higher rates. And that is something that we all need to be concerned about. In fact, 528,000 had already gone to the marketplace between February and the end of March and had gotten subsidies. So it's really important to know that with this added emphasis on the marketplace, it could affect penalties at the end of 2021 when we do our 2021 tax year reporting, because we might see more and more B penalties out there, and we cannot we cannot just guess that nobody's going to the marketplace as we guessed in the past, or potentially not guessed on how many would actually go to the marketplace. So that's very, very important to know. So with all of this and all these new changes, I'm going to now call on my colleague, Tom Neal, to go through what you must do and actually do a call to action plan. Tom?
Thank you, Michelle, and thank you everyone for attending today. And absolutely, that's some really important information. And if the Recovery Act didn't give us enough to think about on COBRA, we can kind of look at this as a cherry on top of the sundae. As a call of action, I mean, we're all advocates for our clients. We want to make sure that they are compliant and covered. And so, I mean, the first thing I would tell you to do is if they haven't done their 2020 filing yet, get it done. That's really important. As Michelle mentioned earlier, we have another deadline coming up. It's late, but it's late at a lower penalty. And if we can get it done by that August 1st, after that, there is no limit on that, and it can really increase. So if you've got anyone out there that has not filed yet for whatever reason, I would definitely suggest getting that in place and getting it done before that date. Know about FTEs, full-time equivalent employees. Your clients that have dynamic workforces, that have the variable hour employees, the seasonal employees, they absolutely have to have something in place that's tracking them to make sure they are covering the people they should cover. Especially with these notifications and the enhancements to the marketplace, they have to make sure they're covered. As they say, the best defense is a great offense. So they want to know this information beforehand so that they are covering the right people. They need to review the affordability, do the changes. As Michelle said, with the increase and basically taking the cap off the increase over the poverty limit, they really need to make sure that what they're offering truly meets the affordability test and that they're covered. And these are things they need to be done now as opposed to in the year. Many employers want to wait till the end of the year to put something together and get the reporting done. The problem with that is if you wait till that point, and there is an issue such as affordability, well, it's too late to fix it. So right now is the time for employers and you as brokers for them to make sure that they have the right service in place, that whoever the vendor or whoever's taking care of this knows what they're doing, has updated according to these new changes, and that they are covered. As number 5 says, don't get caught with surprise penalties. IRS love letters are anything but fun. And the best way to counter them is to not have them at all. However, if they do get a penalty letters, Medcom can assist. And this is open to both clients who have used this in the past and those who haven't. Any employer that has a problem or gets a letter like this, please have them reach out to me. We're more than happy to offer that service and see what we can do to mitigate. I will tell you at this point, the slide says 50 million. I would tell you it's much higher than that. But we've been able to mitigate proposed penalties, and we're more than happy to work with your clients to assist with that. In fact, all of our ACA products can really help. And to be quite honest, before I read the products, the most important thing to have isn't the products themselves, it's the expertise behind it. Our ACA Operations Team has been in place with very little change since the inception of the Act. These people are experts. They know what they're doing. They know how to do it, no matter how complex a certain situation is. And Michelle always keeps them up to date on the latest changes so we can handle it. Obviously, we have our full service ACA employee reporting, but we also offer, as I was mentioning ago, that FTE tracking for those people with seasonal or variable hour employees. We can keep them up to date with live reporting to make sure that they are covering the people they need to cover. As I said, penalty appeal support. Again, that's for any client, whether they're a current client of Medcom or not. ACA backfiling. Not many vendors are offering this, but we can do backfilings. If you have a new prospect or an employer that you realize should have been filing all along, we can go all the way back to the beginning or whatever years they need. So that is a service we can offer. And then finally, we also offer consulting and strategic evaluations. Michelle and her team can act as coaches and really help, especially with some of the more thorny and complicated questions with ACA. But again, the most important thing here is the expertise. When you come or your client comes to us for these products, it's the expertise behind it. They know they're getting it done correctly. And in fact, that goes with all our products. Our main goal is to make sure that A, we're taking care of your clients as it pertains to these products, and B, that we are offering you tools to make you more competitive when you're out searching for new business. We have our CDHP, COBRA, as we've been mentioning, and premium billing administration. We have our HIPAA privacy and security solutions. We also have our health and welfare compliance and actuarial solutions. But again, it's the expertise behind them that really makes these products a great option for your clients. Now this time we're going to hand it back over to Casey and we'll take your questions. But before I do that, I just want to remind you, it always happens to me. I don't know if it does to you, but every time I go to one of these instructional webinars and the question period comes up and I don't have anything, and then the meeting's over and bam, suddenly that question comes to me. It's not a problem. After this slide and after we go through the questions, Casey will put up my email address. Please send me those questions. I will make sure to get you answers. If you need a proposal or if you have an issue, I'm there to help you. Casey?
Thank you, Tom, and thank you so much, Michelle, for sharing your expertise, your information, and Medcom's support for these complicated issues that can be incredibly stressful. If you have any questions, now's the time. Go ahead and submit them into the questions panel. We've had a couple come in. But like Tom mentioned, we are always available to take your questions outside of these webinars. You can reach out to us at any time. If you think of something after this or a different question, we're always here to provide that support that you and your clients need. So Michelle and Tom, the individual mandate was taken away by the former administration. Do you see any change to this coming in the future?
Okay, Casey, that's a really deceiving thought by the former administration. The individual mandate was never taken away. The individual mandate would have had to, could only be taken away by an act of Congress. And we know that the previous administration tried anywhere from repeal, replace, repair, reduce anything on the ACA, and they were never successful in getting it through Congress. The only thing they did was in the Tax Cut and Jobs Act, they reduced the penalty to 0 so that the individual mandate still existed, but the failure to live up to the individual mandate was reduced to 0. Well, we know that President Biden has already said that he's going to do tax increases, and that what he wants to redo is to repeal the Tax Cut and Jobs Act. And when he does that, I imagine that he will add a provision in there that there will be penalties once again on the individual mandate, since the individual mandate did not go away.
Thank you for that clarification, Michelle. What size groups does this usually involve? We work with 2 to 25 size groups with both community related and LFP. So what are we working with here?
Okay, an applicable large employer is an employer that must follow the mandates of the ACA, and they are defined as 50 or more full-time employees, including full-time equivalents. So that if you got all the part-time employees, you add, there's a methodology to adding up those part-time employees to determine if there's full, if they make full-time equivalents. But as long as you have 50 full-time, including full-time equivalents, you're an applicable large employer. And if you are part of a control group, which means you might have 3 or 4 companies that have common ownership, then in order to determine if you're an ALE, you would, an applicable large employer, you would actually look at all of the companies together, add up the total amount of employees, full-time equivalents. And if combined you have more than 50, then you're an applicable large employer and must comply.
So Michelle, you mentioned earlier that there was no statute of limitations and the IRS could come back at any time. And so that means it's none of those rules where we have to keep our documentation for a certain amount of years and then we can destroy it.
Yeah, the IRS always says you can destroy your documentation in a certain amount of years, but that's because of the statute of limitations. So with no statute of limitations, I would recommend that since the IRS can come back anytime, that you must have your documentation to support what you did anytime the IRS comes back with no statute of limitations.
I gotcha. Thank you for that. Tom, can you clarify, does Medcom help with FTE headcount to determine if they are over 50 full-time employees, full-time eligible employees?
Great question. That isn't a service we offer, but I do, if you have a situation like that, please reach out to me. I have a link that I can set you up with. Believe it or not, the IRS has a website, and this one actually is helpful, and it gives great examples, and it shows you how to calculate that, but I'm more than happy to go over that with you.
Excellent, thank you. How do schools count employees who only work 9 to 10 months out of the year?
If they only work 9 to 10 months out of the year, then they are still considered full-time employees if they work more than 30 hours a week on average. A full-time employee is not 40 hours, but 30 hours. And if you have them working up to 10 months per year, then you really must count them when you're doing your full-time employee count. And then at the end, see whether or not on average for the year, you average 50 or more full-time, including equivalents.
So how are we communicating this information with the clients, with the employer? So if we have a change in penalties or information like what we're sharing here in this webinar, are we communicating that to the clients, or are we communicating strictly with the brokers?
We're communicating this with the brokers, and then the clients can, the brokers certainly should be sharing this information with their clients if they feel that they are an applicable large employer, and that some of these questions might have come down to an issue as to what their strategy were for the year, especially for 2021. If they had a strategy, well, we're going to count on this many people going to the marketplace and getting a subsidy, not realizing that the marketplace was going to reopen again.
Absolutely, and any of our clients are able, employers are able to reach out to their Medcom account representative in the ACA department at any time, or brokers can reach out to us and we can provide that information to you directly so that you can share that with your clients.
And Casey, I just want to add to that also, our current ACA clients, their account managers working with them on a monthly, weekly, whatever that process they've agreed on basis. And part of that is they're looking at, is the coding correct? What is the affordable insurance, so that we're making sure that it looks correct. So that is an ongoing process. So that is part of that communication.
Absolutely, thank you. As far as this webinar series goes for ACA, it is a broker kind of specific webinar series. We don't necessarily put that out to our employers. But there's not information in here. There's information in here that if you wish to share with your clients, of course, you are more than welcome to do so. A question here, if I had 50 or more FTEs for the 12 months of 2020, when do I have to offer affordable coverage? At open enrollment following 12/31/20? What if the renewal is 1/1/21?
Okay, the applicable large employer determination is based on the previous year. So that in 2019, if you did not have 50 or more full-time employees, then you were not an ALE in 2020. If 2020, you first became an ALE for the first time, then you would be an ALE for the first time in 2021. So it's always based on the previous year, except if you're a new company. If you're a new company that just forms and you reasonably expect to have 50 or more full-time employees, then you would be an applicable large employer the year that you formed. But typically, for the most part, it's always based on the prior year. And you look at it at the end of the year and said, yep, I do have 50 or more full-time employees, and therefore I must offer them coverage. Now, the IRS also recognizes that full-time employee determinations are done typically at the end of the year, and that might make you scramble to get insurance in place. So they said that if you are an applicable large employer for the very first time, for an example, in 2020, you crossed over that threshold, and now in 2021, you're going to be an applicable large employer for the first time, you will not be penalized if you start your coverage as of April. So you would have 3 months to get coverage in place and start offering a plan as of April 1st.
Thank you for that, Michelle. Just a reminder here that there are the handouts in the handout section that provides a lot of guidance for other issues associated with ARPA. We've also uploaded the no statute of limitations memorandum that we linked in the presentation earlier that you can download. So please take advantage of that. We will be sending a copy of the slide deck and the recording after the presentation concludes. We have one last question that's come in here. For controlled groups, I believe ALE status is calculated across all groups. Is affordability calculated within each group or across the total of all groups?
Okay, affordability is always based on an individual. So you're right, to determine ALE status, it's across all groups. And then for actual reporting purposes, and I always say that you get married and you determine your size with the marriage, and if you're an applicable large employer, then all sums of your of the marriage are applicable large employers. Each EIN is an applicable large employer. And then you get a divorce, and then each EIN files their own separate tax reports to the IRS. And where you come together is a couple of checkoff boxes on the 1094, which says, are you a part of an aggregate group? You would check off yes. And at the very last page, they have you list who your aggregate groups are, who you're affiliated with. But when you're talking about affordability, it's based on the individual. So if an individual goes to the marketplace and gets a subsidy, and for that individual, your coverage wasn't affordable, then you will get a penalty based on that individual going to the marketplace. But each EIN gets their own penalties.
Right. Thank you so much, Michelle. Thank you so much, Tom. And for everyone who joined us today, we will be back for the second part of this series in 2 weeks. The series does run every 2 weeks on Tuesdays at 2 p.m. So thank you so much for registering, for attending, and for trusting Medcom Benefit Solutions to bring you this information. We certainly hope you have a wonderful rest of the day, and thank you again for joining us.